Hello traders, and welcome to another trading psychology meeting with the expert. And as you can see, today the topic of our meeting is 10 trading mistakes, the most popular, the most common trading mistakes that any beginner and even the advanced users, advanced traders can do. So let me just focus on this 10 trading mistakes and the trading psychology that lies behind them. But before we will begin, I have the disclaimer for you. Eventually, this is my very often seen secondary slide that I show on almost any of my presentations. So we're gonna start with the quote from Alexander Elder. I think you know who this guy is. It's a world famous coach, trading coach, by the way. And he said the goals of successful traders is to make the best trades. Money is secondary, right? So this is one of the quotes and the principle I would like to second, because this is something I try to stick very often. This is very valuable quote. So let's take a look at the agenda of today's meeting of the trading psychology. 10 trading mistakes. Can you avoid mistakes? That is the question. Can you trade and learn? And what is the list of the most popular mistakes? And of course, how can you avoid them? The very often repeated, very popular behaviors and straight off resolutions to very popular trading mistakes. It doesn't matter if you are a day trader, it doesn't matter if you are a position trader, if you're a beginner or you semi-advanced, or maybe you're an advanced trader. At some point of your trading career, you've been making plenty of trading mistakes. So let's just focus on them and see what they are and how to avoid them, because it doesn't matter how much you want to avoid them, you will possibly still going to make these mistakes anyway. So at the beginning, my favorite quote. This is, of course, the quote that you've seen many times during my presentations, and it goes like this: one of the biggest hurdles you have to overcome as a trader is staying in the market long enough that you understand the market mechanisms and that your psyche, your learned and habitual reactions are no longer your enemy, and this is why you are making these mistakes. Of course, there's more than 10 mistakes. I'm just presenting the 10 I think the most popular, most common mistakes, but we all know that there's many more of them. But the key thing here is that you need to learn how you really are, your psyche, basically your habitual reactions that you use in everyday life doesn't fit to the trading environment, because they very often lead to the losses and frustration and anger, instead of increasing your profits, to rise your buying power, to rise your capacity of a trading power. So basically, you can make the mistakes. Of course, some of them I will be talking about, but generally, even if you stop making them, there is still a lot of the learned and habitual reactions that are very often unconscious, of course, that you need to deal with. All right, so Can you avoid these mistakes? Well, you are going to have to avoid making many common mistakes that traders often fall victim to. You are going to make mistakes as you learn to trade anyway, but the traders who actually start making money are the ones who learn from those mistakes and figure out how to stop committing them over and over, so they are not habitual. So they are using the feedback from the mistakes to learn something new about themselves. There is basically no other way, no simpler way. Well, it's a little bit time consuming and resources consuming, but however, it's still the best way you can do, the best opportunity you have to avoid habitual and learned reactions to the market behavior and to your own, of course, behavior in the response of the market behavior. So in this presentation I will discuss them, as I said, the most common mistakes that traders make, and I will give you guys some simple, as I said, solutions to them, because after that it's up to you to learn from them and make sure to avoid them as you continue to analyze and try the and trade their markets, right? So please be aware of the fact that you are going to make these mistakes sooner or later, but you need to get a feedback and learn from them, right? So what are these mistakes? Being in too many trades at once and over trading. This is perhaps the most classic mistake that 100% of beginners make, and about 90% of the rest make. Also, no surprise, it's no surprise that about 90% of the traders lose money over the long run, when about 90% of them are trading too much. Another interesting thing about it is that if you find you are in more than like 1, 2, maybe 3 trades at one time, you are probably trading too much if you are the beginner trader, of course, because there is simply no practical, no logical reason to be more in just a few handful of trades at a time, ever, for the beginner trader. Why? Because you cannot focus on all of these trades in the same time, and you cannot follow that correct trading process on every of them. Of course, if you get more experience, if you get more screen time, you can have more simultaneous trades. Of course, most people simply cannot learn to ignore this temptation to constantly be in the trade, so they make up all of the sort of reasons why they should trade, or make up trading signals that are not really there. The cold and hard truth of it is, unless you learn to control yourself and stop over trading, you are never going to make consistent money trading the market. So this is the cold hard truth of all of this. Perhaps the quickest and easiest way to train yourself to stop over trading is simply to change the way you think about trading and what making money trading actually consists of, right? So once you start, remember that the less is more, and that you will literally make more money by trading less over time, right? So you will begin to look for reasons why a potential trade might not work out, instead of trying to find any little reason possible to enter the market, like most traders do. And as we know it, most traders fail in the trading business. The second thing, the trading mistake is spending too much time thinking about trading and looking at charts. Similar to over trading, is generally just thinking about trading too much. The traders often make the mistakes of spending too much time flipping through the charts over and over and over again, when there is no obvious, like a price action signal, your strategy signal. There is no news, there's nothing there, right? As a result, what's end up happening is that they enter a trade they wouldn't normally take if they were following their trading plan. So if you find yourself at the point where you were when you are thinking about the markets and trading, or about the trades you are in, and nearly all the time, it's safe to say that you are also over trading and losing money as a result. So what to do? You must build in planned time away from the charts into your trading plan. Then if you are following your trading plan, those regularly scheduled times you are away from the charts are just going to be part of the plan, part of the process, right? If you start deviating from the process and end up losing money as a result, you have only yourself to blame in this situation. So in the end, it comes down to how good you are at staying disciplined, of course, and sticking to a plan, which is the most which is why the most people lose money at trading, because they simply cannot stick to a plan and they and stay disciplined over a long periods of time consistently, right? The discipline is one of the most important thing in trading, and the traders very often complain about having lack of the discipline or not enough discipline in themselves that is preventing them from profitable trading. Trying to make decisions from short time frame charts. Well, it's the thing is that the lower time frame charts are simply not as important as their higher time frame charts counterparts, because the reason is very simple. The higher time frame, the more data it reflects, and it as we say, it carries more weight than a short time frame, which is full of fluctuations, random price fluctuations, high frequency trading, and so on and so on. A daily chart candle or a bar, it doesn't matter, is just far more important than a 1 minute chart, right? For example, you need more patience to trade higher time frames, but in return you are getting more reliable trading signals and less stress. A pretty good trade-off in my opinion, right? When trading daily charts, you can simply set up a trade and walk away for like, I don't know, a couple of hours to half of a day or whatever, 24 hours or more, and this is how you can of course trade and do the other things, right? So you can trade and enjoying the lifestyle that trading can bring. So you are not glued, you are not stick to this chart over and over again. So you are losing a major amount of time just looking at the charts because you think that this will improve your trading and make you more profitable. It won't. Not in that process, what I mean. And the other thing is that one of the biggest mistakes the new traders make is day trading. Okay, many people hear about the day trading before they learn much about it, and this leads them from down to the wrong path right from the beginning, starting them on a cycle of trading of short time frames, like 5 minutes or 1 minute or even less, for example, right? And this can lead to severe over trading and even gambling habits as well, maybe even towards the trading addiction, because the beginner traders are not really ready for the day trading. For trading just a very low time frames, right? This is my opinion. Day trading is okay if you know what you are doing, and if you know how you can do it, then you can make consistent and profitable results from that day trading, right? If you don't know what you're doing, then well, most likely you're gonna just blow up your account. This is not applicable for everyone, but I would like to put it on my list. The trading with the real money before you have tested yourself on a demo account. Right. So there are pros and cons of trading on a demo account or on any kind of simulators, but This mistake is like a death sentence. It can wipe you out straight off the trading game, and of course blow off your money. And time again, the beginners do it. The mistake is trading with real money before you have before you have even tried your strategy on a demo account will end up in typically a number of things. The traders are not familiar with the account and how it works, so they make silly mistakes like risk more than they thought they were, or not enter a stop loss properly, etc., etc., and this causes them to lose the money, of course, right? So the other thing is, you didn't test your account, your trading strategy on your on a demo account, and you don't even know if your strategy or your ability to trade it will work in the real account, right? You are not sure if they will be effective on the real account. It seems like kind of a stupid and insane that anyone would take their real hard-earned money, right, and just start risking it in the market with zero practice on the demo or on simulators. But hi, people go to Las Vegas and gamble all of the money away. So, well, it's just another form of that. The other thing is that if you try your strategy on a demo account, you have a back test. You can see how your strategy behave in the past. Is it profitable to trade it? Maybe it isn't that much profitable, and maybe you can improve it something. That's the one thing. The second thing is your reaction on the market behavior during the trading hours, right? Despite the fact that this money on the demo account are of course a fake money. You are basically testing your strategy and your response to your strategy behavior and the market behavior. This is the most important thing that people should do before they will try to trade with the real money on the real market, of course, right? So if you planning to become a professional trader, someone who wants to be consistent in making profits on the financial markets, your mission should be testing your strategy as well as your ability to trade it. This is very important on some kind of a good demo trading platform or simulator before you try trading it live, right? This will allow you to work out all of the bugs with the platform that you might not be familiar with, and it's also you will get a feeling for the market and your trading method, your strategy without the real money on the line, right? The aim is not to make the demo money account to grow infinitely and make some stupid things. The point is to get familiar with the platform, with your strategy, with your ability to trade it, and to see how your strategy behaves in the various market environments. The other thing is, which is very, very popular these days, news distractions. This is the mistakes plenty of traders make. The black hole of news distractions is a real thing in the trading world, and if you are not careful, you will fall into it and never get out until all of your money is gone. What happens is that traders end up looking for reasons why their trade should work, right? And as we all know, you can find just about anything you want over the internet, and you can find many opinions, both or against any argument, any analysis, any positions you want to take, trading included. Another thing that happens is that traders go on the internet and start researching economics and trading news and start thinking they have all figured it out completely, and they know what will happen next based on some kind of a website economic news release, right? So then they place a trade based on that opinion, which is of course very, very dangerous, because very often the trading news or the economic news are already priced into the market. In the other words, it's already reflected in the price, in the market behavior, and the institutional traders, the big boys, the sharks, as they say it, they have already acted upon they believe will happen before the economic news comes out. Okay. Then, when the news is finally released, a whipsaw will occur in the market. Market will go up, then go down. There will be very, very quick price spikes in one way, and then the whipsaws back in the other direction. And this is obviously nearly impossible to trade, and it causes most uneducated traders to lose their money and so on. So this is the main reason why you shouldn't trade solely on the news. And the trading. The best thing is to read the tape if you have the tape, if you are the tape reader, and trading the raw price action is one of the best thing to do for the beginner traders in this situation. The other thing that I have mentioned sometimes before is not understanding that every trade has a random expectations. So this is very, very big thinking error that most traders have about trading. Most traders don't understand that every single trade they take has about an equal chance of ending up as a win or a loss. Now, that is not to say you cannot have a high percentage winning strategy, because you can, but the thing about trading is that for any given series of trades, there is going to be a random outcome of wins and losses. So that means you never know the sequence of wins and losses in a sample size of trades. Okay. However, if you expect that your strategy will win 60% of the time, then you can expect that percentage to manifest over a large enough sample size. All right, it is the same thing when you flip a coin. You know that you will get heads 50% of the time and tails 50% of the time, but within that 50% expectations, you can have, say, 10 straight heads in a row, which could be confusing if you didn't understand that you need to flip the coin a lot of times to get 50% of the heads. Okay, the same thing is with trading. You can get 10 losses in a row within, say, 100 sample size of trades, but after those 100 trades, you could still win 60% of the time. The implications of this are massive for your trading. If you don't stay true to your trading plan and remain disciplined even during that losing streak, you are going to freak out and probably overtrade and get so far off course that you will end up blowing up your account, most likely, right? Any one trade means essentially nothing. It is the end result of a large series of trades that will show you whether or not your trading edge is working and your ability to trade this trading edge is actually profitable, right? This also means that you need to manage your risk to a level that allows you to get through a large enough sample size to see your edge play outside. So you need to be in the market and stay in the market during this not much profitable period of time. Okay. The other thing is feeling a sense of desperation or urgency to trade. A huge thinking error that many traders commit is feeling a sense of urgency, of desperation around their trading and to be in the trades. This comes from putting all your eggs into one basket, essentially the trading basket, of course, right? This is a huge mistake because trading is inherently risky and inherently difficult due to the fact that it requires such a mental strength, such a mental discipline, such a mental focus that many people simply don't have or are not willing to develop. Hence, you absolutely must realize and accept that trading cannot start off as your plan A, so to speak, okay? That means even if you get really good at trading and start making consistent profits month after month, you shouldn't absolutely you should absolutely maintain like a side job or a part-time job or whatever, because and not put all of your money in a risk for the markets, right? This is exactly what the beginner traders should do, because very, very often after few trades, after few days of the trading, if you have a beginner's luck, you quit your job, you say goodbye to your boss, you put all of your money to the trading account, and then over the time you just lose all of it, and then you are without the money and without the job to make it up back on again. So basically this is very, very common mistake people do, that beginner traders do. So even if you are trying to learn how to trade the markets, if you are the beginner trader, if you are at the beginning of your trading career, you need to know that it can still be at the beginning your kind of maybe very important for you as a job to do or as an activity, but you shouldn't resign from your study if you are a student. You shouldn't resign from your job. You shouldn't resign from your part-time job unless you making enough money to quit everything else, and if that's your plan, to become 100% trader, right? So this is the correct way to do into this business, right? If there is one way to surely fail at trading, is putting too much pressure on yourself to make money at it, right? So if trading is your only source of income, if you want to only trade, you are under horrendous pressure, both from the economic and psychological side. Trading success comes when you are calm, when you are disciplined, and literally you don't care if your trades win or lose. That may sound silly, but I'm telling you that once you commit too much emotional and mental energy to any one trade or to your trading in general, you have already written and signed off your death certificate in the market. You need to stay emotionless as much as you can, and you need to literally not care about your trades winning, about your trades losing the money on the market within the range of accepted risk, of course, right? So the other things, not trusting your decisions, and of course sticking to them. So when you enter a trade, you need to stick with it unless there is a monumental, massive shift in the price action, in the market behavior, on the same time frame you entered the trade on. Okay, so it's very, 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 very often traders spend time analyzing the market, finding a trade signal, setting it up, placing it up, calculating the risk, calculating trading edge. Then they go back to this trade hour later and start freaking out because the price moved against them a little bit, and they are seeing that as a negative, as something against them personally, right? And this might be seen as a sign that is negative for them and they open positions, and then they close the position with small gain or without the gain or with a small loss. Okay, so if you don't already know this, but there is something I need to tell you, this is normal. You are going to have trades that go negative and you are going to have losses, but if you freak out every time a trade goes against you, you will very quickly blow out your account. So this point goes back to the one before, when I discussed the random outcome of any given trade. You simply cannot afford to give too much weight to any particular trade, because it's stupid to do so when it's the large series of the trade outcomes that really matters, not any singular particular trade. You cannot actually, as I said, emotionally approach the particular trade or even series of trade. You must let them play out and let the market do their job, so that you can trade stress-free and you can trade profitably. So you need to go, you need to get out of your own way and let the trading process and market behavior take over and do their job, right? Do their thinking, as they say. So then you will most likely be successful trader, because you will trading firstly stress-free, or on the less stress, on the lower stress, and basically you will be more profitable. That's the point. And focusing too much on the money and reward and not enough on the process is another trading mistake. When you focus on the reward you can gain from your trading, right? You have to get out of your own way and let the process, the trading process, the market behavior take over. Because most of the traders spend way too much time focused on money and rewards, and relatively tiny amount of time actually focusing on things that matter: the strategy, the trading it properly, the sticking it to it, the discipline, the risk, the managing risk, the managing the position sizing, the trading edge, the setting and forgetting, and stuff like this. You don't need to think about the rewards and profits, because those things are only a symptom of a correct trading process and the correct thinking. They will not come forth just because you are thinking and worrying about them, right? So they are just like a side effects of a correct trading process, the money and the rewards, right? So this is a mistake you're making in your trading as well. And the last thing is, very, very often chasing a signal you missed and entering late at the worst price. Worst price can be, of course, very, very different in different situations, and it happens all the time. You saw a trade setup you liked, you didn't enter for any number of reasons, then you came back later to the chart and saw the price took off in your favor without you abroad it. So you are very, very frustrated, and in that situation, the last thing you want to do is to enter the market after the main move has already been done, okay, without you, of course. You simply have to wait for the next opportunity, and remember that the market will be here tomorrow, market will be here next week. So don't be in a rush to trade or to enter a trade you've missed, because this is emotional thinking that will only cause you to lose money, okay? Chasing a signal you missed and then turning as a FOMO trader, right? Because you got this fear of missing out, that market will definitely this time make this 1000% move, and you are not in it. So you are entering the market on a very, 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 very worse on a very bad level, right? On a worst possible price. This is the mistake that plenty of people, especially the beginner traders, do, because as I said before, they need to be in the trade. They need to babysit the traders. They need to babysit the trades. They need to be in the market all of the times, covered with news and tweets and stuff like this. Because if they not, they think that they will not make the money, which is of course not that straightforward thinking as they should be, and it's very very often the result of mistakes that were made as a snowball effect, right? So the smaller mistakes are getting bigger and bigger over the time, and this is the way you very often are not able to stay in the market long enough to understand the market mechanism and to get to know your own habitual and reactions, right? So this is the beginner's mistake, and even the semi-advanced or advanced traders mistakes that they make over and over again. So please use the feedback, use the information that was given to you by the market to improve your trading. By seeing this and acknowledging this mistakes you make, and try to improve, to make better your trading, make your trading better in your own eyes, without any kind of confabulations, without any kind of straightforward lies, or like sweetening the reality, right? A little bit here, a little bit there, because it doesn't lead you anywhere. It will not lead you to be a profitable, successful trader for sure. So this is something that you should be aware of. That's everything from me for today. Thank you very much for listening to this presentation. If you would like to contact the Global BD Trading Company, which is a proprietary trading company on the American Stock Exchange, please use this means of contact that I have presented here on this screen. So that's everything for me for today. Thank you very much for watching this and listening this presentation, and I hope I see you guys next time. Bye bye.